Good morning. Today is September 14th. I'm Joe Terrell, president of Terrell and Company, independent wealth managers in St. Louis, Missouri, with another video update on our thoughts on the world economy, domestic economy, as well as investment markets. Since our last video, the pandemic has picked up steam, reared its ugly head, if you will, and there has been thoughts that this may shut down the world economy again and create economic difficulties. We see no chance that that's going to happen. We think we've already turned the corner, and from here towards the end of the year, cases should be rolling over and we should be moving back towards concentrating on reopening the world economy. So with that said, we're very bullish on the world economy. The amount of monetary stimulus that has been added by central bankers all over the world, and we'll discuss in a minute about whether that's good or bad, but nonetheless, that stimulus, that amount of liquidity that's been added is out there, and this should keep the world economy and the domestic economy very strong. So with that said, that doesn't necessarily translate to the fact that investment markets are going to be strong. Investment markets have to look out and say, what would things be like late next spring, early next summer? And the question that we all are dealing with is, what is going to happen to inflation? The Federal Reserve Bank and many market participants believe it's just transitory. All this money we've printed and the recent 5% plus annualized inflation rates are going to disappear. It's all going to come back down to 2% or less inflation. We absolutely disagree. Higher rates of inflation are here to stay for the next 2 to 3 years. And there is a price to be paid for just artificially creating $7 trillion in new money. The Treasury Department in the United States sells bonds to finance the budget deficit. The Federal Reserve Bank turns around a week later and buys those bonds in the open market with what's called adjusted Federal Reserve Bank credit. In simple English, they just printed the money in order to buy the bonds. So there was a time frame in the world when central bankers set short-term interest rates and longer-term interest rates were determined by the markets through price discovery. This is all gone. Central bankers around the world, just like our Federal Reserve Bank, they now dictate where long-term interest rates are going to be by going into the open market and buying those bonds at predetermined yields. So we find ourselves in the United States with a 10-year government bond yielding 1.3%, while inflation runs north of 5%. This cannot sustain itself and it cannot last. The Federal Reserve Bank believes that we might be as much as another 2 years before the Fed actually lets this change. We disagree. The Federal Reserve will have to do something much sooner than that and narrow this gap. Either inflation has to come down or interest rates have to go up. You have to get the two closer together to avoid bubbles in the economy and avoid situations where people begin to borrow at the low rate and invest in inflation going up at the higher rate and arbitraging the two. So that leads to investment markets, which we are very concerned about right now. What will be effect on corporate profitability as inflation continues to move higher? We haven't really seen the labor inflation yet enter into this equation, but certainly with everyone scrambling to hire people and with a labor shortage, if you will, it argues very much for the fact that we are going to see labor inflation, which will keep these prices higher. What you don't want to see happen is get into a cycle where prices go up, employees say, I have to make more money, employers raise salaries, this starts the process over, businesses are forced to raise prices, and now all of a sudden you're in the classic inflation cycle. This could happen. We're not ready to say it's going to happen yet, but there's no question we're going to have higher inflation. We need to be very careful with investments. We're somewhat towards the negative side on investments, particularly stocks at the moment, because there's just too many unknown questions in the next 6 months about how all this is going to work out without creating any difficulties. So we are slowly getting more defensive in portfolios, and we are staying with what we call reopening stocks, companies like steel and some of the various companies that actually benefit from the world economy getting back on track to reopening. So we will see, we like companies that we believe are inflation protected, if you will, or maybe have a better opportunity of handling higher cost. Ed, we'll be back, Brian, in maybe 3 weeks, maybe first or second week of October, with another update on our thoughts. Thanks for joining us this morning, and we hope that you and your family stay safe and healthy. Thank you.